September 3, 1929. The Dow Jones hits 381 points. Champagne corks pop across Wall Street. Irving Fisher, one of America's most respected economists, declares that stocks have reached what looks like a permanently high plateau. 56 days later, the market loses half its value. Fisher loses everything: his fortune, his house, his reputation. What he missed wasn't complicated. The warning signs were everywhere. The Federal Reserve had raised rates, steel production was declining, automobile sales were falling, but everyone was too drunk on prosperity to notice. Now, 97 years later, the same script is being read aloud. Only this time the hero isn't steel or automobiles. It's artificial intelligence. Act 1. The euphoria. The numbers are staggering. AI has been called the defining theme for equity markets in 2026, with some firms describing it as nothing short of revolutionary. The AI boom has touched nearly every U.S. market sector and accounted for roughly 60% of recent economic growth. Sound familiar? In 1929, it was public utilities and holding companies. The Dow gained more than 20% between June and September of that year, a 9-year bull run that saw the index increase tenfold. Everyone from banking magnates to chauffeurs was pouring money into the market. Today, South Korea's Kospi surged 76%, thanks to AI-linked chipmakers, while a memory supplier called Kioxia exploded 540%. In a single year, the language is almost identical. Back then, they called it the new era. Electricity and mass production were going to change everything. Profits would grow forever. Today, we hear the same promise wrapped in different packaging. JP Morgan Wealth Management warns that the biggest risk is not having exposure to this transformational technology. But here's what they won't tell you. Transformational doesn't mean profitable. Not immediately. Sometimes not for years. Companies are investing with faith that highly profitable business applications will eventually emerge. Faith, not certainty. Not proven returns, just faith. Act 2. The warning signs. Let's talk about the signals no one wants to discuss. Signal number 1. Concentration. The S&P 500's 16% gain in 2025 was driven largely by AI stocks. While the market's heavy reliance on a few tech giants has created what some call a dangerous single point of failure. In 1929, public utilities dominated the market in exactly the same way. When they fell, everything fell. Signal number 2. Valuation. AI stocks are trading at extreme multiples, with some companies valued at 60 times sales despite generating no profits. These aren't investments. They're bets on future earnings that may never materialize. Before the 1929 crash, stocks were trading at 14 to 19 times, earnings far less extreme than today's AI darlings. Signal number 3. Leverage and debt. In 1929, roughly 600,000 margin accounts existed, with investors buying stocks at just 25% down payment. The rest was borrowed money. Today, the leverage looks different. A typical 1 gigawatt AI data center requires upwards of $60 billion in capital expenditures. Companies are pouring cash into infrastructure with no guarantee of return. But here's the critical difference. Today's AI spending is overwhelmingly being funded with cash, not debt, by companies that regularly generate high volumes of free cash flow. That's good news, right? Maybe, or maybe it just means the reckoning will look different. Signal number 4. Insider behavior. Executives and board members are reducing holdings at a historic rate, while retail investors keep feeding demand through commission-free trading platforms. The smart money is quietly backing away. The retail money is charging forward. This is the exact pattern that preceded every major crash. Act 3. The playbook. Here's how the 1929 script unfolded. First, the Federal Reserve warned of excessive speculation. Then they raised interest rates in August 1929. The message was clear. Stop the madness. Nobody listened. On March 25, 1929, a small crash exposed the market's shaky foundation. But banker Charles Mitchell injected $25 million in credit to prop it up. The same playbook repeats today. When liquidity tightens and credit conditions deteriorate, the system becomes fragile. Everything looks fine until it doesn't. The trigger in 1929, bad news about utility regulation, arrived in October, and utility stocks fell dramatically. What could trigger a 2026 crash? Potential triggers include geopolitical escalation, a major counterparty failure in derivatives markets, a sharp correction in megacap stocks that dominate indices, or a political misstep that undermines policy confidence. The derivatives market alone is massive enough that a single failure could cascade unpredictably. But here's the uncomfortable truth. The AI industry is moving into a period where the market is aggressively sorting winners and losers, with investors demanding immediate return on investment. OpenAI has raised concerns about circular financing, where investors essentially fund their own future revenue. When the music stops, someone won't have a chair. Act 4. The Difference Maker. Now, full disclosure, 2026 is not 1929. The financial system has guardrails that didn't exist then. Bank deposits are insured, circuit breakers hold trading. The Federal Reserve understands its role as lender of last resort. Unlike the late 1990s internet boom, today's AI infrastructure is being built by cash-rich companies with proven business models. That matters. But it doesn't eliminate risk. It just changes the nature of the risk. Wall Street remains almost universally optimistic, with not a single analyst in a Bloomberg survey predicting that the S&P 500 will decline on an annual basis in 2026. Wait, not a single one. In 1929, economist Irving Fisher was heavily invested and remained bullish even after the October sell. Universal optimism isn't a safety signal. It's a warning bell. Closing the question isn't whether AI will change the world. It will. The question is whether investors today will pay tomorrow's price for tomorrow's profits. History doesn't repeat, but it absolutely rhymes. The 1929 crash wasn't caused by bad technology. Electricity and mass production did transform everything, just not on Wall Street's timeline. Investors who bought too early and too high spent years, sometimes decades, waiting to break even. After peaking at 381 in September 1929, the Dow didn't surpass that level again until 1954. 25 years. So what should you do? Stay informed, understand what you own, diversify beyond the hype. As one analyst put it, given the concentration, you need to diversify the portfolio, and you need to understand what happens if you're wrong. The 1929 script is being read again. The actors are different. The technology is different. But human nature, that never changes. Fear and greed, euphoria and panic. Boom and bust. The cycle repeats, because we forget. Don't be the one who forgets. If you found this analysis valuable, subscribe to @FinanceLuminaReal for more deep dives into the patterns that move markets. We cut through the noise to find the signal. Because in investing, what you don't know absolutely can hurt you. See you in the next one.